Well, good afternoon, everyone, and thank you for joining us for today's edition of Talking Tax Reform. I'm Jared Walzak, Vice President of State Projects at the Tax Foundation, and I'm joined by Julie Sforza-Smith of H&R Block and Nikki Dobe of Evershed Sutherland as we talk about mobile workforce and business nexus issues arising from telework. I'm really grateful to both of them for joining today, but particularly want to thank H&R Block for sponsoring today's Talking Tax Reform webinar. Now, if any point in today's talk you would like to ask a question, please go ahead and use that Q&A feature in Zoom, and we'll get to as many questions as we can towards the end of the panel. As we all know, over the course of about a single week in March 2020, remote work was transformed from a luxury for a very few to a new normal for tens of millions of Americans. Telework at levels experienced in the early days of the pandemic was never really sustainable, but the nature, or at least the location of work, has permanently changed for many white-collar workers. But while the workplaces have certainly changed, state tax codes often have not. Employees who work in another state for as little as a day can face tax liability there. And some remote workers, those unfortunate enough to work for employers located in 5 states with so-called convenience rules, or perhaps those who have inadvertently established tax residency in 2 states, could face actual double taxation, fully taxed by 2 states on the same income. A few unlucky taxpayers could even have 2 different states claiming them as a resident. Meanwhile, the employers themselves could find themselves out of compliance with state withholding rules when a remote worker travels without their knowledge. And in some situations, a single remote worker could expose an employer to substantial corporate income or sales tax liability in a state or locality where they previously lacked taxable nexus. Additionally, workers providing client services from new states can expose some corporate profits to double taxation. Employees with newly flexible schedules working remotely from their home in another state, maybe 2 or 3 days a week, like I do actually, will in many cases have to withhold in both states and to account for their work patterns. These outmoded and inconsistent tax rules in the state are an impediment to remote work. They make telework cost prohibitive for some employees and put some businesses in the position of limiting the states from which their remote employees can work. Now, absent reforms at all levels of government, employers and employees alike can face substantial unexpected tax liability. Now, we've certainly seen some of that thus far in the pandemic, but even post-pandemic, there's this uncertainty and this potential for discriminatory taxation that could dampen enthusiasm for greater workplace flexibility, the sort of flexibility many have heralded. You know, we think about mobility right now. We're in an era of unique mobility, but there's 2 types of mobility. You have the mobility to actually physically pick up and leave. You also have the mobility, that opportunity, the ability to rise. And states, there's this unique opportunity right now for people to find the situations, the solutions that work for them. But we have some tax codes that can be getting in the way. Before I talk about all of this, I want to briefly talk about the implications of this mobile work environment, because an era of remote work solves a complex coordination problem, basically by eliminating it for some businesses and their employees. The result is an environment where states' tax competitiveness matters more than ever before. How states respond to this emergence of remote and flexible work is going to influence the trajectory of their economy for, I think, years to come. Well, when almost all work is performed in physical offices like the one I'm in right now, an employer engaged in location decision-making has to find an equilibrium, basically something representing the optimal balance on a variety of different competing factors. They have to balance things like, the cost of doing business, whether it's tax burdens, operating costs, regulatory costs, and labor costs, with things like access to a qualified workforce or quality of life considerations. We're talking schools, universities, transportation systems, amenities, housing markets, all those things that are important to both executives and the workforces they want to attract. They may also wish to take advantage of agglomeration effects. Think Silicon Valley or the range of Silicon Valley clones out there, or the financial service industry and how it's concentrated in New York City, things like that. And depending on their business model, they might need to be close to clients, suppliers, their customer base. But the problem is this is a balance that's overall optimal, but it's never going to be optimal for each individual. You have some employees who would gladly pay a premium to live in a bustling city with live entertainment, a thriving restaurant scene, all of those great amenities. Others take very little advantage of them. And even though they're indirectly paying for them through a higher cost of living, they really don't care. They're not receiving this benefit. Some want a higher level of government services and will accept the taxes in response. Others prefer a different arrangement. And traditionally, when these individual preferences are in tension with each other, the individual kind of loses. A person may not appreciate the amenities they're paying for, but they appreciate working in a field which recruits heavily from people who do. But the rise of remote work really does change that equation. To the extent that teams can operate virtually, employees can decide for themselves which bundle of amenities contribute to their quality of life and which do not. And that's going to be both the cost of living and the tax burden, right? They're going to choose to live accordingly, knowing that their job can follow them there. Now, not everyone who takes advantage of this might do so in pursuit of financial savings. Maybe they care about something else. Maybe they really want to live in a particular city. They want to live somewhere tropical. They want to live by the mountains, whatever it may be. But some are going to move for lower taxes, for a lower cost of living, or for what to them is a higher quality of life, things that can often go hand in hand. Economists talk a lot about tax competition. I talk a lot about tax competition because this is core in my job. But we also have to talk about the constraints because inertia is real. Takes a lot to uproot, and especially that's true if it means finding a new, maybe not as desirable form of employment. People wind up living where others with similar career paths live, not because it's necessarily where they prefer to live, but because it's where their peers live. It's basically the network effect. We talk about that in other settings, but this is basically a network effect. But remote work really makes what's called TBU competition, voting with your feet, way more viable. It leads to a resorting where people are untethered from the geography of the job market, or at least more so than they used to be, can relocate according to other preferences. There's also an unbundling element of this. We talk about unbundling in like cable services, subscription services. We can't unbundle government completely. We can't make it like a streaming package because schools and roads and courts, they're not the exclusive offering of one location. You can't pick and choose. You can't opt out of funding something because you don't need it in government. But nonetheless, with 50 states and thousands of localities, taxpayers can choose many different levels and compositions of government services and cultural amenities and everything else. It's a geographic untethering of their employment here. It's sort of like cutting the cord. They now have all of these additional options. This new environment offers both challenges and opportunities. It enhances state competition, and it allows people to really relocate to whichever locations offer them the best value proposition. That can be an extraordinary improvement in quality of life for many people, including low-income workers, but at the same time, it can put pressure on social safety nets and certain types of investment. There's a lot of things that states and individuals are going to have to weigh. But regardless of what people may like, the reality is that this pandemic-induced experiment in remote work is not going away. We have seen the ushering in of a new era of greater mobility and work flexibility, whether anyone likes it or not. Governments don't get to decide whether they want to inaugurate this era. The choice is really about how to respond to it. And if employees are free to locate, the same is really true of employers as well. They can leave some of those higher cost locations because even if all of their employees don't follow them, that's okay. So they can follow after lower taxes or a better regulatory environment or lower cost of doing business without that fear of losing access to a qualified workforce. So state officials need to think long and hard about how to compete in the increasingly mobile post-pandemic environment. There are opportunities to attract businesses that previously found relocation pretty impractical, or for which tax liability was previously subordinate to other considerations, which are less important in a remote work-friendly era. There's opportunities for states to become a destination for workers who can increasingly live anywhere. And then on the flip side of that, there are policies in some states which, if they're not revisited, could see them blacklisted for remote worker locations. Think, for instance, if a remote employee's presence establishes taxable nexus for the company itself. And they could even drive out existing companies, especially when some states' aggressive tax policies could lead to double taxation of the remote employees, driving a relocation of that business if they want to prioritize telework. So in this context, it's really not a surprise, at least to me, that so many states are exploring or acting on tax reform. We're now, and this might come as a surprise to a lot of people, but we're up to 14 states that have implemented or enacted individual or corporate income tax cuts in 2021. Now, that's the highest in decades. And many other states are exploring meaningful structural reforms that we may see coming into fruition in the 2022 legislative sessions. But to ensure that tax codes are open to telework, there's a lot of work to be done. We have to think about a variety of different things. We need to think about Nexus. We need to think about sourcing rules, for corporate taxes. We need to think about the filing obligations for individuals and the withholding obligations for their employers. We have to think about convenience rules that can lead to that double taxation, reciprocity agreements that can make it much easier to cross state lines on a regular basis. We need to think about the ways that potentially someone's work could be double counted, that the same day could be counted in two states. All of these things matter. So like I say, if states want to capitalize on this, and if they want to give their residents and potential other residents really the opportunities that we think of associated with remote work, then there's a lot of work to be done. So to talk about the state tax policies that affect employers, I'm going to turn things over to Nikki Dobe at Evershed Sutherland, after which Julie Sforza-Smith will talk to us about the implications for employees and for other individuals. So Nikki, if you would, please take it away.
Thanks, Jared. Thanks for having me. Happy to be here and talking about a subject which we hear a lot about these days. I'm sure Julie will agree. She spends a large part of her time talking to clients about how the change in the workforce has will really play out at the state and local level. And so, as Jared mentioned, there was a week, just about a week in March of 2020 where the world really changed. Prior to joining Eversheds, I was with the Council on State Taxation for several years. And one of COSTS, which is the acronym it goes by, one of their primary pieces of federal legislation that they worked on was the Mobile Workforce Bill. And this was really a federal bill that COST had been working on for many years that would have tried to standardize what would happen when people were traveling everywhere. I was operating in an environment like this. I know Jared was, many folks in this area traveling all over, talking to state legislators, speaking at conferences. You spend a couple days in multiple states throughout the year. And if you look at the technical rules in all of those states, I was probably supposed to be filing in dozens, at least a dozen, maybe more states. So the rules are very complicated when you look at them at the state level and almost impossible to comply with 100% perfection. And that was kind of the pre-pandemic world. Then really there the push was, let's have a standardized 30-day bright line test where anybody can kind of travel into or out of a state for up to 30 days and you would be okay. You wouldn't have to comply with that complex spider web of rules. Then with the pandemic, we found people not leaving their houses. And for some folks, that didn't mean that they were stuck. I don't use that pejoratively. They weren't stuck in their own residence. They perhaps went to stay with a family member, or we saw, families coming back together. So when somebody was, perhaps working in a city like San Francisco, living in a small apartment, that became very cramped when you're in that space day after day. So they may have gone to a larger house of somebody that they know, or one of the family members, and had been working there remotely for much longer than 30 days. So really, the mobile workforce concept kind of got flipped on its head with the pandemic, and we saw folks relocating to states that were far-flung, very not in the same region or state as perhaps their employer. And we were just in this whole new world. And so what does that mean? Well, we've long known that having one employee in a state could create nexus for a company. This was true even prior to Wayfair. That was the long held physical presence test. And there was a New Jersey case which found just that one employee in a state was sufficient to create that nexus for corporate income tax purposes. So if we could we have a slide here, which we'll take a look at, that shows a map of where the states are at with respect to nexus for purposes of, telework and COVID-19. So as you can see, the green states are states where an employee being in a state where you perhaps did not have an employee before would create nexus. And then we did see a handful of states provide what has become known as nexus waivers or COVID nexus waivers. And so the states with the blue stripes are those states. And what we saw from those states were states that just said, look, we understand we're in an uncertain time. And so during this uncertain time, you should just kind of stay the course, maintain your filings as you were, and we will not assert that if you have an employee that's working remotely from our state, that they will create nexus. This is a bit of a conundrum with where we're at right now, because I think, I think a lot of us thought maybe this was, I was just at a conference where someone was like, I thought COVID was going to be an 8-week thing and then we'd be done. Definitely not 8 weeks. We're now kind of going on 18, 19, 20 months. And so we are in a situation where things have started to look better. We kind of thought things were looking better this spring. Then Delta came. We've retracted a little bit, but it does now seem like companies are very much looking at either November or the first of the year as the time when they will really start to come back into the office and kind of reinvigorate their in-office policies to the extent they plan to do so. So what does that mean for purposes of those employees that aren't going to go back, the companies that aren't requiring their employees to come back, and these states that perhaps had these waivers in place, but were in place because of the pandemic? I think the answer is we don't exactly know. And I think Jared made very good points about the opportunities that this creates for states to provide some rules that make them more competitive when it comes to issues like this. If we go back to the way in which the world was before COVID, and we go back to our general rules, having that one employee in a state where you are otherwise not doing any business will in fact create nexus and could create a filing obligation on the business side. So for corporate income tax purposes, sales tax purposes, any other entity level business tax, gross receipts taxes, and that can be just the filing requirements in and of themselves can be very onerous. Now, setting aside for a moment just the fact that you have to file a tax return, let's talk about what that could mean. And I will limit it to kind of the corporate or business tax side. An area where, telework kind of creates some challenges is you may have an employee in a state where perhaps you don't have a large footprint. You don't have many sales into that state. And so if that state employs a market-based sourcing approach and single sales factor, there could be a very, very low liability in that state. Perhaps you don't have any tax liability when you look at what the net income is and what should be apportioned to that state. So this is a conversation that I've actually started to have with some of the states to discuss, do they really want all of these tax returns? Do they want a company to be filing a tax return for $100 of tax? Does that make sense for a company to, have to go through the expense and the cost of having that return prepared on their side, and then as well as the state's administrative costs of receiving and taking in that return and processing that information and that check. So I think the states I've cautioned them. I say, there may be an opportunity there. We may see that they think, oh, we're going to get all these new companies filing and this is going to be great. But at the end of the day, the dollars may not be that big when it comes to the corporate income tax side. Organizations like the Multistate Tax Commission have definitely begun talking about the factor presence nexus test, and perhaps something like that makes a little bit more sense, so that you don't have all these very low dollar tax returns. So I do think that this will be an evolving space, especially in the corporate income tax side. And I would reiterate those points that Jared made, that there are definitely opportunities for states to make themselves more competitive in this area. The bigger risk, I think, for Nexus and companies, though, is sales tax. The sales tax, not a direct tax on the entity itself. When you have Nexus for purposes of sales tax, when a company has Nexus or for purposes of sales tax, all that means is that the state has deputized you to become their agent to collect and remit a tax. And if you fail to do that, then that will become your tax liability. So sales tax is an area where I think it does get a lot scarier, and having an employee in a state will create that nexus. We do have the economic nexus thresholds. Again, this came out after Wayfair. All of the sales tax states have adopted those thresholds. There are a handful of different thresholds. Many have the $100,000. We've got states that have $250,000. California has a $500,000 threshold. But an employee in that state could waive that threshold. Now, again, from the state's perspective, they may want to think about, is it worth it? How many sales is that company really making into the state? If they're underneath the $100,000 threshold or the $500,000 threshold in California, again, is it worth the state's time to administer those returns and deal with that? But it is definitely a nexus creating activity, and one that you should be thinking of for purposes of your employees. So I'm trying to see what other slides we have here. So I would go now. This is our corporate. These are the states that have provided some corporate income tax waivers for COVID. And again, I would just reiterate that this is an area that we will need to watch, and that will likely be changing soon as we see the pandemic kind of starting to come to an end, hopefully, and we see the states really starting to get back to kind of business as usual. So I think we'll continue to watch this area. And then I think at this point, I would probably turn it over to Julie to talk about the sourcing rules before I get into some of the withholding issues that can come about based on those.
Great, thank you, Nikki. And Julie, if you want to jump in, Julie from H&R Block. I appreciate those comments, Nikki.
Sure, thanks, Jared, and thank you, Nikki. Nikki touched on a number of tricky areas regarding employers and Nexus, but what I wanted to switch over to and address with this group is wage sourcing at the individual taxpayer level. So, we all know that the pandemic has changed how we did things. You're hearing this over and over again. So what I'd like to do is just touch on that very briefly, and then describe the income sourcing framework currently used across the country by states. And what this means is, how are states statutorily requiring taxpayers and individuals to source their income based on where and who they work for. I think Nikki will then go back and talk about withholding taxes, and we can consider some future issues and considerations for individual wage sourcing. But first, I want to start with a brief story. And I think it's very illustrative of what people across the entire country are dealing with right now. And I guarantee about 90% of us on this call are experiencing this and understand this quite well, this scenario. So Tammy is a 58-year-old woman who lives in Maine in a 55+ community with her 2 cats. And for the last 25 years, Tammy has commuted from her home in Maine to her work at a major Boston hospital, where she's a drug purchaser for the hospital's pharmacy. So each year, over the past 25 years, Tammy has filed a Massachusetts non-resident income tax return. And on that return, she would report all of her employee wages to Massachusetts. And although she also needs to file a Maine resident tax return, reporting all of her Massachusetts wages on her Maine return, Maine will offer her a credit for taxes paid to Massachusetts. In that way, she won't be taxed on the same income in multiple states, the one where she lives and the one where she works. So obviously, we're keenly aware of how drastically the coronavirus pandemic has changed our work routines. Suddenly, people like Tammy, who've never worked away from their workplace, such as a large Boston hospital, found themselves doing that. Massachusetts implemented stay-at-home orders in the early days of the pandemic, like many other states. People like Tammy found themselves working at home every day in the company of their favorite cats, or maybe your dogs, and your children. And, you know, she would be working at her kitchen table with her hospital issued laptop, filling out drug orders and submitting them for the hospital. In an effort to preserve revenue, states like Massachusetts and others like Connecticut, Georgia, and Rhode Island enacted emergency wage sourcing rules. And in this way, they sought to retain taxation over employee wages for all these employees that essentially were fleeing large urban areas to work remotely due to the emergency orders and the stay-at-home orders. You know, a change in work location, especially a temporary one or de minimis one, has little impact on how a worker's wages get taxed by states. I know Jared referred to something we'll talk about a little more is, you know, just one day in a state, working in a state, basically open a taxpayer to wage withholding or taxes in that other state. While, you know, that is not necessarily the case, it's still a possibility. Certainly from the Nexus side, like Nikki talked about, having a worker in another state from where the employer is based certainly can create nexus. On the individual taxpayer side, it's a little different than that, but they are very intertwined. You know, after months of remote working due to extended stay-at-home orders, an individual's tax situation does become a bit more ambiguous. We're not talking about one day. We're not talking about 8 weeks. As you know, Nikki said, someone, you know, myself included, oh, this is going to last for 3 weeks. No, it didn't last for 3 weeks or 8 weeks. This is now, you know, a year and a half. And it's very uncertain how that will change and when. You know, and although the concept and the existence of remote work is not new, it's the rapidity and the unexpected shift of a large, massive scale of workers that is creating this tension, and it amplifies the consequences at a tax level for remote employees. You know, and this shift has begun to fray the edges of wage sourcing rules between states, because what once was, you know, a small subset of situations for certain taxpayers that really didn't change very often. You know, someone who's going to work remotely, you know, they would talk to their employer, they'd figure out the wage withholding, but it was a more permanent situation. Now we're faced with a reality that is very impermanent and up in the air and maybe not constant. And most likely, like what we're going to see in the future is a hybrid work environment, or even going forward, you know, people may not ever go back to their urban work locations like they used to, or they may do it in a modified way. And that fraying of the edges for the state wage sourcing rules really happened most notably between states that have a large cross-border workforce, and also those states with differing income sourcing rules. So that's really where the tensions started to cause some problems for individual taxpayers. To understand the implications of remote work relative to state income taxation, we need to understand what the sourcing rules are, right? So this is where Nikki, really wanted me to jump in and talk about this, is how do states source income? Because that will inform how employers are required to withhold taxes for their employees. States typically use one of three methods. By far, the first method, is used by most states, and that's physical presence. There is a physical presence test for Nexus. Similarly, there's one for employees and how to source income based on their physical presence, where they actually do their work. The majority of states will attribute employee income to the state where the worker physically earned it. This, like I said, is the physical, we call the physical presence test. If you travel to work in a state where you don't live, like Tammy traveling from Maine into Massachusetts, that individual is subject to income tax on wages earned in the state where they perform their work. So Tammy, that's why she would be subject to taxation in Massachusetts. The worker's home state will still include all of the worker's income. So wherever you're resident, you would still file a tax return in that state, just as you always have. But that state typically will allow a credit for taxes you paid to your work state. And in that way, the taxpayer is precluded from paying tax on the same income in multiple states. In Tammy's case, she'd file a resident Rhode Island return and get a credit for taxes paid to Massachusetts. There are some issues with that kind of sourcing, that kind of credit, though, that we can get into if people have questions about that. The second type of income sourcing test that states employ to source income is the convenience test. As Jared said, there's 5 states that source an employee's income using this rule. What this means is the state statutorily attributes employee income to the employer's workplace, regardless of where the employee performed the work. These states include Delaware, Nebraska, New York, and Pennsylvania. Connecticut employs this rule on a reciprocal basis, meaning they will apply the convenience test if the state where the other taxpayer lives or works also uses a convenience test. So in that way, it's reciprocal. It creates a level of fairness between the states on who's taxing the income. Interestingly, Arkansas eliminated their convenience test this year. They were one of the formerly 6 states that use this test. So really, we're dealing with 4.5 states right now, with Connecticut as a type of half state or a conditional state. Notably, New York, has used, they're just very aggressive in reaching their arm out and attaching sourcing of income for employees that work in New York but live elsewhere. So, we have the physical presence test predominantly used by most states. Then we have the convenience test, essentially the opposite of physical presence, where the employer's location will dictate where the employee's wages are sourced. And then there's a third type of income sourcing used by states, and this is called reciprocity. What this means is that a state with reciprocity, they will have an agreement with another state. Typically, we're talking about border states and neighboring states. And these agreements allow each state's residents to pay tax on wages only in the state where they live. So, we have a large workforce that moves between DC, Virginia, and Maryland. and a lot of people on this call are from that area. And what these 3 states have is a reciprocal agreement. So it creates a type of simplified tax regime where if you live in Maryland and are working in DC, you're going to source all your wages to your home state of Maryland. DC is not going to tax you. You file with your home state and pay tax there. Residents of DC will do the same thing if they're crossing over into Maryland to work. And in that way, these allow for both states and taxpayers to be relieved of some considerable tax filing burdens and administrative tax burden. So, those are the 3 types of sourcing rules they have between states. And Nikki, if you want to take it back and talk about the withholding issues at the employer level now, this might be a good time to do it. And then I could go back to talk about future wage sourcing considerations.
Thanks, Julie. Sure. So if we want to go back, first, there's a map in the deck that does show the states that have the convenience rules. So you have that there for your information. And so that's that map. And then if we flip ahead to the next map, this is a map that will provide some information regarding what information and guidance the states provided with respect to withholding during COVID. So as Julie mentioned, fabulous job of laying out what the different sourcing methodologies are for purposes of personal income tax. What does a non-resident owe a state for purposes of personal income tax? Very often, and the general rule is that the state, an employer will be required to withhold based on a state's personal income tax sourcing rules. This is a general rule. I've found a few states where that's not the case. Oregon in particular, have done some deep diving there, and Oregon has a very clear physical presence test when it comes to withholding. And then they have some a bit odd rules when it comes to the personal income tax sourcing for non-residents and those rules. But as the general rule is that if you have an employee, you need to look at what is the state's rules for purposes of the sourcing of personal income tax and what income tax would they owe to that state. And those are the rules you look to. This issue became very confused during COVID because we had so many employees either not going to the state where they used to work into these large metropolitan areas that were used to getting a lot of withholding based on the workers physically being present in those states. What we saw most states do was say, please just hold the party line. Let's kind of continue down the path of status quo. And let's not upset the apple cart. Again, when we thought that this was going to be an 8-week or a 6-month issue, those types of rules made sense, perhaps. I think there's some folks that are in states that don't impose personal income taxes where they aren't quite so happy with those status quo rules. But in many cases, I think this did just create some ease for compliance for employers as they were able to just kind of continue to administer things as they had normally done. Now, as we come out of COVID, I think it's going to start getting very messy as you have employees in lower tax jurisdictions that are going to feel less happy if you've got a state that perhaps has a convenience of the employer test where that state is going to continue to assert that wages, 100% of an employee's wages should be withheld upon in a higher tax jurisdiction. Even if that employee is in a lower tax jurisdiction where they may be getting a credit, they're obviously not going to receive the benefit of the full benefit of that credit. So this, again, I would say another area where the states have a lot of opportunity to create rules that will make them more competitive. I would also hope that we would see some movement on the convenience of the employer test generally, and we may see something like that go away. Jared, would this be a good time to talk about the New Hampshire versus Massachusetts case?
Yeah, I think that'd be great.
Okay. We did receive a question asking about the New Hampshire versus Massachusetts case. This is a case that New Hampshire filed against Massachusetts back in October of 2020. Massachusetts, a state that does not generally have a convenience of the employer test, but for purposes of COVID, they were so kind and they said, hey, employers, you just keep on withholding the way you were withholding when all of the employees were coming into our state. We're just going to make this so easy peasy for you. And it turns out New Hampshire, the live free or die state, didn't take very well to that, since they, of course, have no income tax. And there many residents who had previously been going into Massachusetts and been subject to that physical presence test, which was A-OK with New Hampshire, but when they were required to work from their home due to orders of pandemic, emergencies, New Hampshire didn't take very kindly to that. So New Hampshire filed a complaint against Massachusetts in the U.S. Supreme Court in October 2020. That is the venue that states have to sue each other. It was very sad to see that the Supreme Court ultimately dismissed that complaint and did not decide to hear that case. That happened, I want to say it was several months ago now, but it was very sad to see that, the Supreme Court ultimately declined to hear this case. Now, there could have been a few reasons for that. First of all, there was a question of what was the harm to New Hampshire itself. Was New Hampshire the right plaintiff? Here, I think New Hampshire would argue, our residents are being harmed. We're trying to protect our residents. We do not tax our residents, and Massachusetts is now imposing its tax on our residents, and they are receiving no benefits from Massachusetts. They're not going into the state. Massachusetts isn't offering up these residents any sort of services. So that, I think, was New Hampshire's position. Again, the Supreme Court rejected that. And I think that the other, if there's one valid reason I can give the Supreme Court, it's that, this case could be filed by an individual that is actually harmed by Massachusetts withholding. So again, it was very disappointing to see the court not address this case, since again, it's the only venue available for a state to sue another state. But I think the court, looking at it, just thought this wasn't the right plaintiff, this wasn't the right case. New York is one of the biggest, I will say, offenders when it comes to the convenience of the employer test. And we do have two cases that have been filed in New York by individuals taking on this convenience of the employer rule again. Julie, did you have any thoughts on that?
I'm very close to the New Hampshire issue, Nikki. I'm a New Hampshire resident, and for 15 years, I did work for a Massachusetts employer and lived in New Hampshire. And so I did not file a Massachusetts tax return because I lived in New Hampshire. And multiple members of my family, one of them that works in, two of them that work in Boston, are basically in that boat, in that exact boat. So there's a lot of taxpayers right now that are really not happy with Massachusetts extending their long arm into this becoming a convenience of the employer state under an emergency rule. And a lot of New Hampshire taxpayers were basically forced to file a Massachusetts tax return pay taxes to Massachusetts on their wages when they never set foot in the state and maybe still aren't in the state. And it's not a temporary situation anymore. So it was very disappointing to me too. I might have shed a couple tears. Senator Pappas and a senator from, I believe, Connecticut filed a complaint. And Pappas really was trying to represent his constituents here in New Hampshire, me included, who really took issue with what Massachusetts was doing. So I agree with you. I was very disappointed.
Yeah, I also just think, to your point, how was this for the convenience of the employer? I mean, we are in a pandemic under a lockdown order for much of this period. And it is, I will just say, obnoxious that Massachusetts is, it's one thing if a state has a long-standing rule, but for them to change the rule during this and try to wedge it into this rule where, we have had the highest court in New York at least bless it, and the Supreme Court decide not to take that case many years ago. It is very disappointing that it didn't make it up, but fingers crossed, we'll see one of these cases go.
And that whole terminology, convenience of the employer, it's really a misnomer because
Agreed.
It has very little to do with anything about convenience. It is just a way to ensure more taxation by the state where an office is. There's one final point before we go to maybe a Q&A session that I wanted to bring up. Nikki, you talked about this a little, but I just wanted to accentuate it. Is when we think about sourcing on the business side, as Julie talked a lot about sourcing of income for individuals, but we of course apportion income for corporations. And what's key here is that when we are apportioning corporate income, one of those factors, often in many states, the only factor is sales. It's the destination of sales. For tangible property, that's really easy. It goes somewhere. That is the source. For services, it's a little more complex. Sometimes there's look-through rules. There's a lot of questions about, where is that service? But most states have this market sourcing, which you alluded to. And market sourcing says, where is the destination? Where is the benefit of the service received? Or failing that, where's the address of the company or the individual who's receiving the service? The other way to do this is called cost of performance or income producing activity. It's to source the sale of the service to the place where it's performed. So in practice, most companies that are providing outward facing services, they're not locating their service sector side in those cost of performance states, because then that state's going to apportion that share of corporate income to them. And when they sell it into most of the other states, it's going to get a portion there too. Double taxation, not terribly hard to avoid if you just locate your facilities in certain places. If, however, your service employees are now remote in many cases, and they wind up in those states with cost of performance sourcing, you have a significant problem. You do have double taxation. And I think the solution for a lot of companies is just to draw lines around states and say, you can't do this here. And that's not ideal for the states that would like to have those individuals. It's not ideal for the individuals who can't go there. And to the extent that companies get this wrong or decide they can't impose such a policy, it's putting some burdens on them that are really inappropriate. So in addition to, Nikki, what else you said about maybe changing some of those Nexus standards, I think just solving this, every state is probably going to need to look at going to market sourcing to have that uniformity and to eliminate this disincentive.
Well, I would just jump in on that, because for cost of performance, I think, and I hadn't really thought about this too much before, but cost of performance just got a whole heck of a lot more complicated, because most cost of performance states require that you have the majority or greater than 50% of your income producing activities or your costs to perform those services within the state. If you've got one or two employees in a cost of performance state, I would take that case on a contingency fee basis. That's not going to be greater than 50%. So I think that, the states will struggle. And I think it could actually end up being an impediment, as you say. Either companies will just draw a line around those states because they won't want to deal with them. But I also don't know that the risk is so great that it would ultimately result in double taxation. But to your point, the complexity it's going to create, do we want to continue to deal with all this complexity in this area when the majority of the states have already moved in the market sourcing direction. So I think that will add to that conversation for sure.
Yeah. So we've received a lot of great questions. Some of them I'm going to try to get through really quickly in the interest of time. So one individual asked if there are any states with an individual income tax that don't provide a credit for taxes paid to other states. And I'll just answer that no. Every state that has an income tax provides that credit. The only real variation we see is that most, but not all states do it to the limit of what you would have paid in that state. So simple version, if their tax rate's 5% and the other state's tax rate is 10% on the same income, they're going to credit you on how much you would have paid at their 5% rate. They're not going to give you an additional amount in most of these states, but everyone has that.
Jared, can I jump in on that one for a second as well, because there's an additional little quirk with this. And I can illustrate it with New York and Vermont. So New York is using a convenience of the employer test and basically reaching their arm out to source anyone who works in New York's income to them. We've had people up here in the Northeast that have basically been working from Vermont for months and months. Vermont is a physical presence test. So the taxpayer is subject to tax on their wages in Vermont. Vermont has a credit for taxes paid to another state, but it's only limited to the income you earn in that other state. So basically a Vermont person working in Vermont, a taxpayer, who now has to source based on physical presence all their income to Vermont, and New York, who's coming to grab it and source it too, is precluded from getting that credit because of the technicality on how that statutory credit is defined.
Yeah, absolutely. And that is the case just generically with most of these, unless there's been some sort of waiver. That is the fundamental way that a convenience rule is likely to lead to double taxation, that credit will not be available to you.
Right.
Another quick question I'll get to before throwing one out to the larger group is that question of whether a remote worker would who files for unemployment if they're laid off, which state do they do it in, especially if the employer doesn't have physical presence there. And employers pay into the system based on where the employees are, and that would be the system that the employee would use. Now, an employee can be in multiple states over the course of the year. We're not talking about like spending a couple of days for your employer, but you could be employed in different locations, and then generally states split those costs, so it can get a little more complex. And you still draw benefits from where you're resident, but the states will then reallocate that. But it's where you are as an employee, not where the employer is. I do have a question. Maybe this would be good.
Jared, could I make one point on that? Because in the Western states, the states have also started to pass things like family leave. And Washington just passed a disability insurance, or it's part of the unemployment kind of suite. But those are getting really complicated based on all these rules, and companies are getting a lot of questions about, if I've got a remote worker in Washington, do I then need to pay into that system? And so I think we're going to see a lot more complexity in those areas as people kind of get more mobile, but less mobile. I don't know which way it's really going, but.
And Nikki, we had a question, I think it's good clarification for you, saying, substantial economic presence tests for income tax, that's what's usually needed to overcome the interstate commerce clause, whereas physical presence is used for sales and use, but Wayfair changes that. Just asking if you had any comments on that, the difference there.
Well, I think post Wayfair, the general consensus is there's no real physical presence nexus standard anymore, even though if you have a physical presence, it creates nexus. So we're a little bit whipsawed these days. But yes, the new kind of, because there had been so many income tax cases at the state level prior to Wayfair being decided, the majority, I think the states would clearly say economic nexus has been the standard on the income tax side for a long time. The physical presence test, I think they would have held to sales and use tax. And then with Wayfair, we see that topple as well. So I think the general consensus is economic nexus for all all jurisdiction, all nexus, for all types of taxes, is the kind of the going forward standard.
Yeah. And Julie, someone on the webinar said that their company is recruiting for their first fully remote position and was interested in best practices and getting them started going down the right path. Are there anything on the tax side that you would encourage them to think about beyond what we've already said?
Do you mean the taxpayer or the employer?
The employer.
Yeah, I would I would probably bump that out to Nikki, but really there's a patchwork of requirements and rules for withholding based on the statutory wage sourcing for income, and really the employer has to understand the current set of rules, which are not really speaking to or aligning well with the current realities of a hybrid work environment that most people in the country are now functioning under. So it's going to be tricky. I think it's a very fact-based determination that these employers are going to have to make based on the employee situation. Nikki, I saw you shaking your head. So it's not going to be easy for employers. This isn't a bright line test. There may be some withholding rules that the employer knows about, but then they have to look at the employee's situation and say, all right, you're going to work in the office 3 days a week. What does this mean to what I have to do under state statutes to satisfy withholding requirements? And then they're going to have to look at the other state's rules. If that employee works in another or is going to be working from another state, they're going to have to look at both sets of rules and figure out what to withhold. And Nikki, feel free to jump in there.
Yeah, I mean, first of all, there are certain planning opportunities that businesses can utilize to help kind of contain employees within certain entities to try to manage some of the complexity. So, there definitely do speak with your provider about those types of opportunities. But I would say base level is really just coming up with policies and procedures, because you are going to have to know where these people are. I've been consulting with several clients on what does that mean? Are they going to look at the VPN information on an employee's computer to know what state they're in? Are there privacy concerns? So there's just a whole host of questions that the business side will have to work through, but developing those policies and procedures, implementing them across the board, because to Julie's point, you've got to know where these folks are, because the last thing you want is you find out you've got an employee in a state where you weren't filing, you weren't paying sales tax, and now you've got some significant issues. So I think getting your arms around it early and trying to understand the lay of the land is very important.
Oh, well, thank you. We have a lot of other good questions, but we also have a ticking clock here. So I do want to wrap us up, but clearly from the conversation that we have had today, there are a lot of issues that states need to grapple with, and also that both employers and employees will need to take into account as they are considering the options available for them. There is this uniquely competitive environment right now where states have an opportunity to stand out, to attract remote employees, to attract employers who may no longer be as tied to one location as before. There's also a real need for states to provide clarity, to provide some certainty to business taxpayers and to individuals, and to adjust some of these thresholds to avoid tax burdens and compliance costs that may be out of all proportion to the actual revenue, if any, that would be raised by the state. There's just a lot of difficulties here because we have tax codes that were not designed necessarily around this sort of work. I mean, when we think about some of the Nexus issues, we're going back to an Eisenhower era law, federal law, that was crafted as a short-term solution to be really addressed the next year. So we were supposed to fully address it in 1958. It's 2021. We haven't addressed it. A lot has changed since then. There are certainly a lot of outdated elements of tax codes that need to be addressed. These will be top priorities, I think, for a lot of organizations, including the Tax Foundation, in the coming years, and something that we'll be continuing to focus on. So thank you, everyone, for joining the call. Thank you, Nikki, for participating, and Julie for both participating, and for H&R Block support for this Talking Tax Reform webinar. Thank you to everyone who joined, and we will see you at a future session. Thank you.
Thank you. It's been a pleasure.
Thanks. Bye.